In this presentation we are going to talk about a municipal bond. But what is a Muni bond? A Muni bond is a debt issuance made by state or local government, and what makes it different from other type of bond issuances is that they are, firstly, exempt from filing and registration. They have what's called an official statement instead of a prospectus, which includes legal opinion, and in addition they have lower coupons because they get certain tax exemptions. There are two main types of municipal bonds. The first type of municipal bond is the general obligation bonds, which are backed by the full faith and credit of the issuer. And after there are the revenue bonds, which are only backed by the revenue coming off a specific project, otherwise there is no guarantee by the issuing government. The general obligations are divided in limited taxes, which have a legal limit on taxes, and the unlimited taxes, which does not stipulate any tax limit at all. Muni bonds are issued by government, and there is a credit risk that depends on the type of the bonds, for instance, economic health, financial condition of the government, and its fiscal responsibility in the past, and also it is good to know how much existing debt they already have. Or it is also important to know the unfunded pension liabilities, which may limit the cash available to pay down the debt in the future. A tool that we use to assess how much revenue is available for a revenue bond is something called debt service coverage. We want this ratio to be high as possible, and it is simply the annual gross revenue less operating cost and maintenance cost divided by the debt service. Another tool is the feasibility study. This gives you some ideas on the ability of the project to generate the necessary revenue to meet its debts and all its other obligations. The flow of funds is telling you what the priority of payments are coming off from a project. The debt statement tells you all the different types of debt obligations. So we have direct debt, which is all the debt issues, the net direct debt, which is the direct less the self-supporting debt, and there is the overlapping debt. One state may have one tax, another country another tax, and a school district yet another. Then there are all coterminous with each other. These are different kinds of revenues bonds. One of these is particularly interesting, and it is the private activity or AMT bond. In this case, the bonds have been issued to finance private projects, so they are no longer get the full benefit of tax exemptions. This is 10% or greater of the proceeds of the revenue project, or 10% or greater of the proceeds are secured by private property, not government entity. They are called AMT bond because they are subject to the alternative minimum tax, which means they can be taxed as federal income. Moody and Standard & Poor's rank the different municipal bond issuances with a separate credit rating process, MIG for Moody and S&P for Standard & Poor's. From what we saw in this previous slide, the key thing of Muni bond is that, with very few exceptions, the interest income of these bonds are tax exempt. So one thing we might to know is what will a taxable investment have to yield to be equivalent to our tax exempt Muni bond, and so we could compute the taxable equivalent yield as in this example. For example, we have a 7% Muni yield for someone with 30% marginal tax rate. Now, our taxable equivalent yield is personalized, and it really depends on what your marginal tax rate is. So it could be different for each type of investor. We take, for example, 7% yield, and we divide it by 100% minus the 30% marginal tax, and we get 10% taxable yield. That is what any other investments, for example stocks, bonds, would have to yield to have the same return as our tax exempt 7% return on our Muni bond. Now, to finding out what a tax-exempt investment Muni bonds would have to be to equate a taxable investment that we have in mind. In this case, for example, we have a 5% investment and we want to find out how much Muni bond would have to yield to equate that 5% taxable investment. So we take our 5% times 100% minus our marginal tax rate of 30% and we get 3.5%. So now we can compare our 5% investment with our tax-exempt 3.5% investment. In conclusion, let's have a look at the market, in particular on the OTC markets and the resources available. There are, for example, brokers that only deal with banks and brokerages. They provide information, services, and they trade based on notifying the highest bidder at the end of each day. Also, we have something called Bond Buyer, which is a daily paper which provides sales information and news on the Muni market. In particular, the Bond Buyer placement ratios gives us an idea of supply and demand balance, and it is compiled every week. Bloomberg's MCCR function allows you to search a file of more than 1 million outstanding municipal bonds based on criteria of your choice. The main search screen in the figure at the left shows a search for bonds issued by Philadelphia institutions of higher education. Instead, the spreadsheet at right gives a page of the resulting list using the default headings. For example, a $154.75 million bond by the University of Pennsylvania is highlighted. Clicking on a row in the spreadsheet, we could have additional information about the bond, for example, the type of the bond, in this case it is a revenue bond, the borrower, the maturity, the coupon value and the frequency, the ratio price over yield, and the tax provision. Below there is also a table in which there is a description of the bond rating, following the Moody and the Standard & Poor's rank.